You know that feeling, right? When you're watching a market go completely vertical. It just feels like chaos, pure emotion, a stampede of greed and fear. But what if inside all that noisy, unpredictable chaos, there's actually a hidden structure, a repeatable geometric pattern that we can measure? Okay, let's dive into this.
So here's how we're going to break this down. We're going to start with the chaos, then find the simple shape hiding inside it all. We'll look at how that shape echoes through history, learn why we need more than just one tool in the toolbox, and finally figure out how to use this as a kind of map for navigating the market.
All right, first up, let's just sit with that feeling for a second. That moment a price chart stops making any sense and just goes parabolic. It seems like it's driven by nothing more than pure crowd psychology.
I mean, we've all seen it happen. A stock, a commodity, some crypto, it starts to climb, and then that climb gets steeper and steeper until it feels completely detached from any kind of reality. It's like the rulebook for rational investing just gets thrown right out the window.
And this right here is the big question. What if we've been looking at it all wrong? What if underneath all that emotional noise, there's an actual blueprint, a simple, measurable shape that just repeats itself over and over again?
So what is this magic shape? Well, it all comes down to something we learned about in grade school. The core idea here is that we can actually measure the anatomy of these huge market blow-offs using a simple right-angled triangle.
We call it the incline triangle. And really, it's just a tool for turning a messy, chaotic price chart into a clean, measurable geometric shape. And we're not just drawing it on the screen, we're drawing it in the two dimensions that matter most in any market: time and price. And the beauty of this whole thing is its simplicity. You only need 3 key points to map out the entire event. First, you've got the anchor. That's where the big run-up really begins. Second, the apex. That's the absolute highest price the market hits, the very tippy top. And third, the corner. That's the point directly below the peak at the exact same price level as the anchor. Boom. Just like that, you've captured the entire spike in a defined shape.
And this is where that simple shape becomes incredibly powerful. You see that vertical leg? That tells us the intensity of the move. You know, how big was it really? And the horizontal leg? That gives us the velocity. How fast did this whole thing happen? Suddenly, we're not just saying, wow, it went up a lot. We have actual measurements. This lets you see the order in what looked like pure chaos, and that gives you a huge edge.
Okay, so we can measure the past. Great. But how does that help us with the future? Well, this is where the framework really starts to get interesting. Because once we can measure these events, we can use history to sketch out what might happen after the peak.
We can actually go back and look at famous blow-off tops from history. Think about the massive silver spikes in 1980 and 2011. By measuring their inclined triangles and seeing what came next, we get these historical templates. Now, they're not guarantees, of course, but they are real, data-driven scenarios for how a current event might play out.
And what history shows us is that there are pretty much 2 main types of aftermaths. You've got the Class 1 decline, which is a total trap. You get a sharp crash, and then this really convincing bounce that sucks everybody back in, right before the market keeps falling to its final low. Then there's the Class 2, which is more straightforward. Just a longer, simpler grind down from the peak to the bottom. Knowing these 2 patterns exists, that alone can help you avoid some classic mistakes, like buying back into a falling market way too early.
And here's a really critical lesson from looking at the past. The market almost never just goes back to where it started. In fact, what the data shows is that it often overshoots, falling to a final bottom that's even lower than the original anchor price. The market doesn't just take back its gains. A lot of the time, it takes back more.
Now, as powerful as this geometric tool is, it's not a magic wand. The best, most robust analysis never, ever relies on a single instrument. We have to be looking through more than one lens.
The principle here is called triangulation. Think of it like surveyors using multiple points to pinpoint a location. In analysis, you gain so much more confidence when different, independent tools are all pointing to the same conclusion. That agreement builds a much, much stronger case.
So here's what that looks like in the real world. You've got the spike geometry, which acts like an architect, sketching out the possible shape of the event based on those historical examples. But then, alongside it, you might have a machine learning model that's looking at broad economic factors, things like interest rates, inflation, to forecast the general trend. And then maybe you have another model, a specialist that's been trained on nothing but market crashes, kind of like a crash expert, to predict just how deep the fall might go.
But what happens when they don't agree? Well, that information is just as important. When the geometry tells you one story and the machine learning models are telling you a completely different one, that is a huge red flag. It's a signal of deep uncertainty, or maybe that the fundamental rules of the market are actually changing, what a lot of analysts call a regime shift.
Okay, so let's tie this all together. It's so important to understand what the goal of this whole approach really is. This isn't about having a crystal ball. It's not about predicting the future with perfect certainty.
No, the real goal here is decision support. It's about using this structural context to make better, more disciplined choices. It can help you identify zones where you might want to accumulate on weakness. It can give you the confidence to avoid buying at the absolute peak of the hype. And it can help you sketch out potential price floors where a falling market might finally find its footing.
But I think this is the most important thing to remember. These are incredibly powerful research tools, but they are not guarantees. The market can always do something it's never done before. Past patterns are a guide, not a certainty. So in the end, that's what this really is. It's a map of probabilities. It's not going to tell you exactly what's going to happen next, but it gives you the structural context of where you are right now. And trust me, having that map is the key to making more informed and way less emotional decisions when you're faced with chaos.
And that kind of leaves us with one last thought to chew on. If something as complex and emotional as a financial market bubble has such a simple geometric signature inside it, well, where else in our complex world might we be overlooking elegant, simple structures hiding right there in plain sight?